As we look at the board right now, the regular trading session is closed, so we are looking at the latest official closing figures for Nokia stock, listed on the New York Stock Exchange under the ticker NOK. As of the final bell on Friday, June 26, 2026, Nokia settled at $13.01, marking a sharp drop of 7.01% for the day. This slide was paired with an absolute massive spike in trading volume, hitting over 142 million shares moving through the market, which is significantly higher than its usual daily average. If you are sitting down with your morning coffee trying to figure out if this is a massive warning sign or a major buying opportunity, you are not alone. Most people looking at this chart see a legacy telecom company getting dragged down by a broader technology sector pullback, but the actual data underneath this move shows a completely different narrative playing out behind the scenes. While the headline numbers show a rough week for retail investors watching their screens, the underlying mechanics reveal that institutional players are quietly loading up on shares during these exact dips. Just a couple of weeks ago, JP Morgan updated its outlook on Nokia, issuing a strong buy rating with a price target of $21 per share. When you contrast a $21 target with a current price sitting just north of $13, it becomes clear that Wall Street sees a massive disconnect between the general public perception and the core fundamental value of this company. This structural divergence is exactly what creates opportunity for anyone managing an individual brokerage account or looking for a solid long-term setup. The mainstream crowd is treating this like the old cellular company that lost the smartphone race 2 decades ago, but the reality is that Nokia has quietly repositioned itself as a structural backbone provider for cloud infrastructure and high-level artificial intelligence networking. Think about how most people approach the market today. If you open up the popular retail options like the Robinhood app or look through trending names on various investing sites, the conversation is almost entirely dominated by retail giants. Everyone wants to talk about Tesla stock, Apple stock, or how Nvidia stock is driving the entire semiconductor market. That makes total sense because those companies are flashy and highly visible in consumer markets. But smart money often looks for the pick-and-axe suppliers that make those massive operations function in the first place. When you utilize tools like Schwab Intelligent Portfolios or seek out structured investment help to build a balanced portfolio, the focus shifts toward finding companies with strong cash management and essential enterprise contracts. Nokia fits this description perfectly because it is securing deep cloud partnerships with the biggest infrastructure players on Earth. Just last week, Nokia confirmed a massive expansion of its alliance with Amazon Web Services to integrate its autonomous networks fabric directly into the cloud. This allows telecom operators to achieve high levels of automation by using digital twin systems and advanced software agents. A few days before that, they announced a major integration with Google Cloud to embed specialized software agents directly into their assurance centers, which aims to cut network troubleshooting times by up to 80%. When you look at how much data is being pushed through data centers right now by companies like Microsoft and Amazon, the physical networks connecting these facilities are under immense stress. Nokia is providing the precise hardware and software solutions needed to keep these systems online. If you are involved in self-investing or use specialized platforms like Interactive Brokers trading systems, observing how these enterprise contracts translate to stable cash flows is a fundamental step in analyzing long-term equity health. Let us look closely at the recent technical chart action because that's where the short-term tension lives. Before this recent 7% drop, Nokia had been on a phenomenal run over the past year, climbing from a 52-week low of $4 all the way up to a high of $17.45. That's a massive return for a stock that many retail traders had written off as dead money. However, this rapid ascent created a classic technical setup on the daily charts. The price action recently formed a bearish head and shoulders pattern, breaking down below its 50-day moving average. For shorter-term traders utilizing the Fidelity trading platform or managing active portfolios on SoFi Invest, that technical breakdown triggered automated sell orders, which explains the huge surge in volume to 142 million shares on Friday. It was a technical flushout, not a fundamental failure of the underlying business. This is where the psychology of expectation versus reality becomes incredibly useful. The general expectation among casual observers was that Nokia would just continue its steady march toward $20 without a hitch, supported by political tailwinds like their $30 million manufacturing facility expansion in Pennsylvania. When the reality of a broader tech sector sell-off hit, it cracked that short-term optimism, causing weak hands to exit their positions rapidly. But when you look at the reality of their enterprise contracts, their balance sheet, and their upcoming quarterly financial report scheduled for July 23rd, the long-term thesis remains completely intact. This gap between short-term technical pain and long-term structural value is precisely why major institutions use these moments to accumulate shares while retail accounts are panicking. Comment below how many shares of Nokia you currently hold, or if you are planning to add to your position before the next earnings report drops. It's always fascinating to see how different people manage their individual brokerage strategies when a high-volume tech stock takes a sharp turn like this. If we look across the broader ecosystem of online investing, many individuals tend to use a robo-advisor or pre-built setups like the SoFi robo-advisor, or select specific Fidelity mutual funds to manage their risk automatically.
That's a fantastic approach for core wealth preservation, but for those who prefer an active approach through active investing or dedicated online investment accounts, understanding the specific mechanics of a company like Nokia is essential. The business model here is no longer about selling consumer hardware. It's built on long-term telecom contracts, licensing a massive global patent portfolio, and providing fixed networks, IP routing, and optical networking systems to enterprises and governments worldwide. This gives them a recurring revenue stream that is far more predictable than typical hardware consumer electronic cycles. When you analyze their historical performance, you see a business that spent years cutting costs, shedding unprofitable divisions, and optimizing its research and development spend. This discipline has shown up clearly in their financial statements over the last year, helping the stock rebound over 100% from its lows. They've built an incredibly stable foundation with an attractive valuation compared to many overextended hardware companies. While many popular tech names are trading at price-to-earnings multiples that require flawless execution for the next decade, Nokia remains priced at a reasonable level that leaves plenty of room for upward re-rating as their cloud network business expands. Whether you track your assets via Fidelity Investments apps, watch your data on Robinhood stock trading platforms, or execute sophisticated options trades through interactive brokers platform setups, the underlying value metrics tell a very consistent story. Looking forward into the second half of the year, several clear catalysts could drive the next major leg up for the stock. The upcoming earnings report on July 23rd will give the market its first clear look at how these recent cloud agreements are affecting top-line revenue and margin expansion. If the company can show that its enterprise segment is growing fast enough to offset any cyclical softness in traditional mobile networks, the narrative will shift rapidly from a legacy telecom player to an indispensable cloud infrastructure asset. Additionally, institutional interest remains exceptionally strong. When major global firms like JP Morgan maintain an aggressive upside target, it acts as a green light for other fund managers looking to allocate capital away from highly valued megacap names into more defensive, value-oriented technology plays. Of course, no equity investment is entirely without risk. Macroeconomic pressures, changes in corporate capital expenditure budgets, and intense competition in the telecommunications infrastructure space are variables that every investor must monitor closely. If major telecom carriers decide to delay their hardware upgrade cycles due to prolonged high interest rates, Nokia could see short-term revenue friction. This is why investors utilizing sovereign wealth tracking tools, checking high-end investing sites, or relying on specialized investment help always emphasize diversification. Balancing high-growth components like standard semiconductor listings with stable cash-generating infrastructure plays is a standard method to protect capital while capturing upside. When we look back at the contrast between what the market expects and what the reality presents, Nokia is a classic example of a stock caught between its past reputation and its current execution. The crowd looks at the daily chart, sees a red day on massive volume, and assumes the story is over. The deeper analysis reveals an enterprise that is deeply integrated into the plumbing of modern artificial intelligence networks, backed by solid analyst upgrades and major cloud partnerships. By keeping a clear focus on the fundamental data and ignoring the short-term noise that often floods popular social media feeds and basic trading apps, you can see the structural setup for what it truly is. As we head toward the next corporate report, the tension between this temporary technical pullback and the expanding fundamental value will continue to be the main driver of opportunity for patient, observant investors.